All right, man, it is time to have some serious fun right now, okay? I absolutely love trade management because here's the thing that you'll find. Profitability has more to do with the way that you manage your trades and less about your win rate, okay? So this is powerful, powerful stuff right here that I want to teach you. There's no wrong way to do this. The wrong way to do it is not having a trade management plan and not knowing what the hell you're doing before you get into a trade, okay? That, as long as you're not doing that, then you're not doing this wrong. And then what we want from here is I want to give you all of these options, and then you will test them over time with the way that you like trading, with the kind of trader that you develop into, and you'll see what is more effective for you and what is less effective for you, and then you will gravitate towards what's more effective. Also, I don't believe that there is just one style of managing every single trade that you're going to take for the rest of your trading career. That's just not how I roll. I think that there's different styles of management for different trade setups, and also when you run into different things, like for instance, we'll get to the walkaway method, but this is something that I think is very valuable. It's helped me tremendously in my trading, but I wouldn't just give it to you and say, hey, use this method. Okay, it's used for a specific when you're going through specific challenges in managing your trades, being that, well, I won't jump into that yet because I want to cover the other ones, and we'll go through each of these, and just know that each of these has their place and each of these is valuable in the right context and things like that. You certainly can just use one. So a lot of you will gravitate towards using this first way of managing trades. And that's because this is it's a phenomenal way to manage your trades. It usually not only gives you profit if the trade goes against you, but even if you have your stop loss open and it's not to break even for some reason, like let's say that you went to 1-to-1 and then you moved your stop loss to half break even, or you chose not to do that, then you'll still walk away minimizing your losers. So if you can take off 25% of your trade every single time, then every single time you get around having 4 losses, it's sort of like you have gotten 4 losses for the price of 3, because you've been able to capture 25% of your profit at 1-to-1 every single time. And so 25% times 4 is a full 1-to-1. So in essence, you're just canceling out one of those losses, which is pretty dang cool in the long run. Right off the bat, it may not sound like much, but it really does add up over time. So let's go through this. Let's talk about it all. Man, I love this section. Okay, so what I'm going to tell most of you to do, okay, especially if you're just starting off at trading, especially if you're the kind of trader you really don't know when to let trades go and just take profit and walk away. You're that kind of trader that just hangs on to them, until kingdom come and things like that. You need to get in the habit of taking some profit off, okay? You need to get in the habit of actually managing your trade and taking charge of that trade, not just putting it on and saying, all right, here we go. Like I'm just gonna hold it. And so many times you get to a point where, it looks amazing. It looks great. Wow, can't believe it's this high, to, okay, all right, well, I don't think it's turning. Well, it's coming back now. Oh God, what's going on? To the point where you walk away with no profit. I don't want you to walk away with no profit, okay? In very specific circumstances, maybe I want you to walk away with no profit some of the time, but that we'll get to in a minute, okay? Sounds like it goes against the grain. It actually does, but it serves a higher purpose, as they say. Okay, so with the first method, what you're going to do is you are going to put on a trade. Let's see. Let's just go ahead and find a recent price action here. How about this right here? This just happened today. This was a break and retest. Perfect. Execution. Okay, so let's execute this perfectly right here. Okay, so for the trade entries, you've kind of got the idea now that you'll be entering at the end of the candles. We've already kind of gone through that together. And so that's where we're going to be entering all these trades. I just place it a little bit down just to account for some spread. We're trading Euro USD. So oftentimes the spread on this is like, you know, zero point zero 0.01 pips, zero point zero 0.02 pips, things like that. So it's going to be very, very close to your actual entry candle. We're getting in at the last 2 to 3 seconds of our engulfing candlestick pattern in this example. And with every trading pattern, you're always getting in last 2 to 3 seconds. Put our stop loss, you know, maybe somewhere around there. Actually, I want to go through the stop loss specifics so I can stop saying, you know, around there, around there. So now you can know exactly what we're talking about. So stop losses, you have these choices, okay? Right here, so in our stop loss is going to be above the pattern, okay? Above the pattern is just going to be right there. So usually when I'm talking about a pattern, I'm usually talking about a momentum reversal or a double bottom. So basically a momentum reversal, because usually you're going to have a high point of that pattern. So remember, you'll have your bullish momentum, you'll have your doji, and then you'll have your engulfing. So your high point is going to be right there, and oftentimes the doji will be a little bit higher. It'll stand out a little bit more. So you're going to go for the high of the pattern, okay? So the other area is behind support and resistance. This is going to be your more conservative area. You're just like, hey, listen, you know what? I've got breathing room now. Price can come back. It can throw in another pattern if it's going to continue towards my TP, but it's got space to do so. I'm not worried about getting stopped out. This isn't a real tight trade. I'm not going for, you know, a super tight stop loss or anything. This is going to be your conservative approach, okay? The next one is going to be above the pattern. So you're just going above the pattern. There's no, you know, exact to the pip amount that you should be going or anything like that. It could be, you know, about right here would be above the pattern. It could be somewhere like this that is above the pattern, as long as it is above it, okay? Now, the next one, this is aggressive, okay? Sometimes it works great and you get a really nice high RR and you're like, wow, this is awesome. Other times you're like, man, you know, price came and it just stopped me out with spread, and now, you know, of course it's moved like, you know, 15, 20 pips in my favored direction, and I'm not a part of the trade anymore, okay? That's going to be right at the high of the candle. So in this case, the high of the candle is right there. Like that is literally like as close as you can get to the high of the candle, but that's what that's going to look like. So just to get a feel for it, like the most aggressive in this example, you know, we've got basically like 4.5 pips. Right here, we're going to go above the pattern. We're more looking at about 5.5, 6 pips. And then for above, in this case, what is the level of resistance, we're looking at about, you know, 8.5 pips, something like that. So, you know, the most aggressive to the most conservative, you're looking at about twice the stop loss, okay? You're going from about 4.5 pips to about 8.5 or 9 pips, something like that, just so that you can get a general idea. It's going to vary on every pair. You know, your pips are going to be different for the stop loss. Euro is going to be lower. Pound yen is going to be higher. Take that into account. But just to give you a general idea, these are the 3 areas that you have the option of placing your stop loss. So right here, then above the pattern, and then above your support and resistance, okay? So let's keep it simple. Let's keep it easy. We need something that we can replicate every time. We're not looking for any crazy, you know, I forget what it is that you use for the... it's an indicator that tells you, you know, this is generally what spread is. And so then you're taking that into consideration and adding that on. Generally, what I would do is place your stop loss and then add on maybe half a pip. Okay, add on about half a pip for spread. So if we're going above the pattern, then we do something like that, okay? If we're going above the support resistance area, then we do something like that. If we're going above the key area right here, above the entry candle, then we would just add in a little bit, you know, maybe half a pip or so, just so that you're accounting for a little bit of spread. And then you're just going to replicate that over and over and over again. And as you actually take trades, as you actually put in the work, then you're going to find what works best for you, and you're going to find what works best on certain trades. So like for me, if the pattern, if the entry candle is bigger, okay, if it's a bigger entry candle, so it would need to be bigger than this, like maybe down here, then sometimes I'll just put my stop loss at the top of the entry candle. If it's smaller like this, then a lot of times I'll just go for like a mid-range distance kind of above the pattern. So mid-range meaning I don't want to go all the way above the support resistance area, but I don't want to go all the way to the top of the candle. So I think I'll just pick somewhere above the pattern that at least gives me a little breathing room. It at least allows for price to come back and potentially make a double top and not stop me out of the trade. That's important because often price will go down and then it'll kind of just come back around the same area, sometimes a little higher, sometimes a little lower, put in a double top. Sometimes it has a valid entry, sometimes it doesn't, and then it'll go. And if it does that and you're too, close, you will get stopped out and you just won't get to be a part of that trade. And it's a horrible feeling, and it will happen. You will have trades like that, and that is just part of the game. But the more you trade and the more months you put in and everything, then the more you'll be able to fine tune that, and you'll just see with your eye and you'll be like, no, I'm going to go a little bit wider on this one, okay? And don't feel the need that you need to squeeze your stop loss up way tight, okay? It's not necessary, it's not needed. So give yourself some room, come out here, put your stop loss, above your resistance level. Be generous with going above the pattern. You don't have to make it super tight. And then if you want to be aggressive, you've got some experience under your belt. Maybe you've got a really big entry candle, and also if the entry candle is really massive, a lot of times I just won't take the trade. I'll just be like, you know what? I'm good. I'm not gonna have a 12 freaking pip entry candle. I'm good. I'm just gonna skip out on this one. No shame in that whatsoever. So with this one, let's say that our entry was right about there. I'd probably be right about somewhere around there for an actual stop loss, okay? So we've covered the stop loss placements. You can play around with those and you will find different circumstances that you like to use each one. You'll find a pattern one sometimes you like to use. You'll find one behind the support and resistance depending on what the setup looks like and things like that. That's going to come with practice. So now we're going to talk about TP, okay? And then we'll get to this management. So let's talk about the TP. So we've got a few options. Our first option is a recent 1 minute area. In this case, a recent 1 minute low. So where's our 1 minute low? It's right there. As simple as that. We can put it on just like this, target the recent 1 minute low, done, okay? Our other option is, this example isn't going to work really well, so let's go to a different example to find a 15-minute low. Actually, all of these have kind of dumped right now. Okay, this one. So this one right here. So let's find out if we have a potential entry right there that we can play off of for this example. So we don't. Let's find something else. Let's find maybe this would actually be a really good example right here. Let's see if we have a potential trade up setup. So we don't. And remember, every single time we don't have a valid entry, just think of that as your butt being saved. Like, just think of that as like a saving grace. Like, okay, great, awesome. Not losing any money sort of a thing. Let's go down here. I like to grab examples as close to real time as I can. Let's see. Let's see if there was... No, that one's not going to be a great example for this. We could possibly grab this. Okay. Nope. So what I'm looking for is I'm just looking for a 15-minute area, because that is the next place that we can target, is actually a 15-minute area. So there might be a trade in there. Let's go ahead and just take a quick peek. Okay, not one in there. Let's just use this example then. Let's just use the one that's already laid out right here, just because it's very easy in front of us. It's recent. So all we're doing is we're pulling out to the 15, and then we're just looking for where is a recent 15-minute low in this case. So in this case, it was right here. This was kind of an area that I pulled that was a potential support resistance area as well. And then here is the next 15-minute low. Okay, so here's the first little pullback on the 15-minute. First low right around this area. Second low right there. So you could have pulled this trade down to first the 1 minute low, which this would be a little bit just not enough profit for me. So I would just pull it down, right around this area. Doesn't matter if it's here, doesn't matter if it's here. It just matters that it's in a logical place. Price has recently made this 1 minute low, and that's what we're going to target. And if you would have targeted this, then you would have just hit your full take profit. I chose to target a 15-minute. So that's the next area. Sometimes these 1 minute and 15-minute areas will correlate as well. So the same low that you see on the 1 minute, you zoom out and it's the same recent low on the 15. If prices had like a 1 minute pullback and then it's just like shot up with green 1 minute candles, then you'll just see that pullback on the 15-minute and then just green candles. Then the next area would be a lower recent 15-minute low. Okay. Just an area that's going to act as support and resistance, a pullback, not rocket science, keeping it very, very simple here. And now, as you can see, where, trades start to get into like, 1 to 7s, 1 to 10s, 1 to 12s and things like that, then you can see how there is a need for management. Like, dang, you wouldn't want to take every trade and just say, okay, here's another 1 to 10. It's either going to hit take profit or I'm just going to get stopped out or something like that. So you're going to want to capture some profit. Let's find another example right here. So with this example, targeting a recent 15-minute low right here, area of support and resistance. Right here, this area, targeting a recent 15-minute low right there. Let's go here. Let's see if we can. No, so I think that that's good. So I wanted to show you one more example of a 15-minute. I'm sorry, a 1 minute area, and maybe we'll just do that right here. Okay, so right here, our 1 minute low was right here. Okay, so this actually could have been targeted as a recent 1 minute low. That's completely fine. There's a little pullback, a push up. That's fine. Just wasn't enough profit for me. That's completely fine if you want it. There's nothing wrong with taking a 1-to-1. There's nothing wrong with taking a 1-to-2, especially if you are starting out, especially if this is just everything's kind of new to you, or if you have a lot of bad habits that you built up, which most of you probably do, just peel it back. Just go for a 1-to-1, go for a 1-to-2, go for a 1-to-3. You can totally target this recent 1 minute low. This is the next 1 minute low that you can target, and then we get into our 15-minute lows that we can target. The other option that we have is let it run. Okay. The let it run option is a really, really good option if you're okay with, just, hey, I'm not going to lock in a specific target price. Instead, I'm going to let this go, especially if it's an overnight trade and you're going to go to bed and then kind of like wake up the next morning and you're okay with like, oh crap, it was at this profit point right here, this point of profit, but then it came back while I was sleeping and things like that. You just need to make sure that like you're okay with letting the trade run. That's a conscious decision that you have to make, and know that you won't always walk away with more profit. You could actually walk away with less profit than if you would have just simply, picked a close by area or things like that. But I'm going to teach you some management techniques that you can do so that if you do let it go, then it makes sense for you. Okay. So one of those is, let's see, is managing your stop loss. So we're going to take variations of this management technique and we're going to apply it to just like this. We're going to do it with the just you're letting it run. Okay, so first let's go over the regular management technique. I guess we'll just call it the regular one because it's utilized a bunch. So let's say you get into the trade. Okay, as soon as the trade gets to 1-to-1, you're taking a 25% off. So let's say that you're trading with 4 lots on this trade. You're just going to take one of those lots off. And what I like to do is I'll just go like to 1-to-1, and then I will grab my trend line tool and I'll just mark out 1-to-1 real quick. And then I'll just drag it to 1-to-2, and then I'll just mark out 1-to-2. Okay. Easy as that, easy peasy. So then just put it to wherever you're targeting. I think in this case I was targeting like something like that. So as soon as you see price, get to your 1-to-1, boom, lot off. Okay. As soon as it gets here, boom, 25% off. Then at that point, and I should say that when you get to 1-to-1, you have the option of bringing your stop loss to half break even, bringing your stop loss to full break even, or keeping it open. Okay. And the reason why I say keeping it open should be an option that you can test out is because a lot of times price will come back and it will put in a double top. It will come back right to your entry, stop you out, and then continue to go. So that's something you need to test over time in the way that you trade. But those are your 3 options. If it gets to 1-to-1, you can totally keep it open. You can move it to half break even. If you do that, times when the trade does go against you, you are going to be completely minimizing your losses. Not only have you taken off 25% of your trade for profit, but you've also minimized your stop out. That's absolutely beautiful, okay? But you need to find out what's going to work best for you. Don't get married to one of these ideas right off the bat. Know that these are options that work, okay? That's all you need to think in the math. Options that work. So, or you could bring it to full break even and take off 25%. The other way that you can do it is you take off 25% at 1, okay? Then you make your decision about your stop loss. If you leave it open, when you get to 1-to-2 and you take off 25% of your trade there, then you can either bring it to half or you can bring it to full, okay? So at that point, when you get to 2, you're either at half or you're either at full. You're protecting at least, part of what you've got. You're not going to have this full stop out and it's not going to turn into a loser on you once it goes to 1-to-2. You can definitely play around with those. Then at that point, you are at full. You're either at half or full, and then you're hitting TP, okay? And what I would recommend is that once you start going past 1-to-2, then you really start thinking about bringing that to full break even, because at this point, you're sitting in profits. The trade, the price is past 1-to-2. And it really makes logical sense. Okay, hey, now I'm going to throw it in break even, and either it's hitting break even and I just have the profit that I got from my partials, or it's hitting take profit. And at that point, you can walk away, you can go do other things, you can set an alert at your TP down here and it'll alert you when it hit take profit. You can set an alert right here. Well, hold on a second. You can set an alert right here. I don't know why that my alert is doing that right now. I might need to go into the settings and fix that. That is weird. Usually I click on this and then it gives me the opportunity to set my alert. But anyway, as long as you haven't messed with your settings, it should do that. You just click that right there, set alert, save, you're good to go. And then okay, if I hear that alert go off on my phone, I'll go check the trade. If not, I'm going to, spend time with my family. I'm going to do something. I'm going to work on a hobby. I'm going to, work the side hustle, that sort of thing. Okay. So the other option in there that I want to talk about is the trailing stop. This one is so important because you can lock in profit. As soon as price, like for instance, let's take these off real quick. So as soon as price got to this area and it put in this consolidation, and remember how the 200 was running right through, it was consolidating right around it, and then it had this drop. I was like, you know what? I'm going to lock in profit because I'm not comfortable with this coming back and walking away as just a break even trade. I want to walk away with profit. Now, that's not every trade. Some trades I am comfortable with. I'm like, you know what? I'm cool. If this trade comes back and it's break even, I'm fine with that. Maybe I've had a really good week with trading. Maybe I don't have the time to manage this trade right now. I have other things that I need to do. Whatever the case may be, with this one, I was like, no, I'm locking in some profit. I'm fine if it comes and it taps me out, but I'm not getting tapped out without profit. So I trailed my stop to, after it made this move, to right here. So you can do that in any of the methods that we're talking about, whether you're hitting a 15-minute low, whether you're hitting a 1 minute, whether you are, taking some off at 1, taking some off at 2, you can always, always, always utilize a trailing stop. And if you want to be really, really conservative about it, hey, I want to give price a lot of room to breathe, do it somewhere up here. If you're like, hey, I want to be aggressive, I'm like ready to be out of this trade right now, you can just follow price down. Now, no, if you follow price down, like for instance, if price makes this move and you're following it, a candle or two behind with your stop loss, you're probably going to get stopped out pretty quick because you're not leaving much breathing room for price. So just understand, you can be more conservative, you can be more aggressive, you will find out what works best for you, and especially with specific setups and like what you've got going on that day, where your priorities are at. Some trades, I'm just like, you know what? I'm not going to wait all day. Like this morning when I had the trade on, I was just like, you know what? I could go for more, but I've got a lot to do today. This is a really logical, good area to target for a take profit. I am totally fine if this taps me out and at this take profit and then just goes way, way further without me. I'm not going to sit here and manage it. So you'll have to make those choices, and you'll come across them all the time, and you will become very, very excellent at managing trades and making those decisions. Okay, so that's your take profit. One thing I would note is that just when you're using your trailing stop, that's your trailing stop. When you're using your trailing stop, probably a more logical place to put this was after price had a pullback and then a break, you're leaving it at the pullback, okay? For me, I wanted to capture more profit. That was more important for me than saying I want to give it breathing room. I think it's going to go down further. I wanted to be like, no, if it comes up above this point, I'm out of the trade. I'm good. So just be aware of that. So let's play this out a little bit. Okay, I wasn't sure if it had one more push to the downside, but oftentimes what you'll see is that if you place your stop loss right here above a recent pullback before a break, then oftentimes price will dilly-dally around, come back to that area, and then have another drop. So if you want to be more conservative, give it breathing room. Keep that in mind. Go with a recent pullback. Go with a previous high in this case, things like that. Okay, I think that was somewhere, it was about right there. Okay, so that's the old trailing stop. So let the rest run and move stop to half, full break even, and then half or full break even at 1 to 1 or 1 to 2. Okay, so let's talk about, and by the way, I should say that when you're letting a trade run and you just like let it run for the TP, the trailing stop can be amazing to use because then you can actually lock in profit on the way down, on the way up. And there's no particular way to do it. The way that I would do it, like for instance, if this was running, what I would do is, well, it doesn't really go any lower. I mean, this is the low that it makes and it comes right back. But, and I would just go to break even after it had made this move. So let's find an example. This is actually an example right here. This is not a picture perfect trade, but you could have taken this trade as a double bottom momentum reversal. Okay, let's say that it's like that, and let's say you're just gonna like let this sucker run. Like you are letting it run, dude. You're like, come hell or high water, bro. I'm letting this run. Okay, we'll just drag it all the way up to the top. Okay, so how you would manage this with a trailing stop, and I do everything with a trailing stop manually. I don't have a, some automatic thing or anything like that that manages it for me. I just do it all. So what we would be looking for are places where prices pulled back and then broke. Okay, had a pullback and then broke. And then all we would do is we would just trail a little bit away from those areas. So as soon as price came up here, had a pull and then broke, well, then we could say this is the potential low area for price to come back. So in our logic, we're thinking, well, price probably isn't going to break past this. Now it does break past that and continue, but that's kind of our logic, what we're trying to do. So then we want to let it make a nice move up. Maybe after that happens, then we can trail right here. Okay, it's made that, it's pulled back. Okay, it's making a little move here, it's pulling back. Okay, then after that, maybe we'll edge it up a little bit closer like that. Then it comes up here. Maybe we're right here. We're falling behind. Okay, we're not like following price like, okay, it just broke, we're right here. It just broke, we're right here. We're like, we want to give it room, bro. So then it comes back down here. We see this sign right here. And, maybe if you're like, oh man, I think this is going to come back on me. Well, maybe you can just put it at that price. But if we do that, we're kind of, what is the right way to put this here? It defeats the purpose of our trailing stop, because the purpose of the trailing stop is to give it room, because we think, hey dude, there is a lot of momentum here. We think that this can go a ways. Okay, so after it does, some price action up here, we can move it a little bit more. Let's say that it breaks this high right here. We can move it a little bit more. Maybe we get stopped out here, maybe we don't. If we don't, it breaks this, come back, makes a new high. Now we're waiting here. Breaks this, comes back, makes a new high. Now we're waiting here. Breaks, pulls back, makes a new high. Now we're waiting somewhere in here. Pull back, new high, maybe somewhere in here. Pull back, new high, somewhere in here. Okay, boom, we're stopped out like that. Okay, now you don't have to manage it like that. That's just the way that I manage it. It makes logical sense to me. If you want to just say, hey, I'm waiting for price to make a big move and then I'll sit behind that big move. Okay, great. You're waiting for another semi big move and you want to sit below that. Awesome. Another big move and then you want to sit below that. Awesome. And then it's basically just consolidating through here. Another big move, then you want to sit below that. Completely fine, dude. You will find what works best for you and you will practice managing these different styles. Okay, so the walkaway method. This is something that I came up with when I realized that I was taking my trades off early, and what happened over and over and over again was the trades would routinely hit my take profit after I closed up the trades. So like I'd take 25% off at 1, take 25% off at 2, and then I would, maybe it would go a little bit further and then I would close the trade because I would be like, man, I really want to lock in this profit. I think it's going to turn back on me. I think this, I think that. And so what I did was I said, you know what? I'm going to put a trade on and I'm going to walk away. I'm going to go do something. Seriously, bro, I've put trades on and I've had to get out of the office, away from the screen, or else I'm going to mess with those trades, okay? Go play tennis, go eat some cookies, go take a shit, okay? It doesn't matter. I've done all those. And the point is that it gets you away from the screen and you can't tinker with your trade. If you're one of those guys who's, leaning over your freaking keyboard and you're sweating and you've got to do something with the trade, and every single candle is making your heart, race and things like that. And here's the thing that's important. That's okay. You can work through that in other ways and bring down your heart rate and all of that stuff. But if you are messing with your trade and you find that after you mess with your trade or after you close your trade, then it eventually hits your take profit, that is at the point when you could use the walk away method. Okay, this is not for somebody that's messing with their trade or whatever, and then they're like, oh great, I'm so glad I took some off, I'm so glad I closed it early, because routinely your trades go against you. This is for the person that routinely you're sitting there and you're like, what the hell, I took the trade off and now it's hitting my original take profit. This is the method for you. So simply put, all you're going to do is, after you execute your trade, you've got your take profit, okay? You've got your stop loss. They're all plugged in and ready to go. And then what you're going to do is you have two options, okay? One is more aggressive. One is a little bit more conservative, okay? I want you to walk away from that trade, and I want you're not even going to manage it. You're either hitting take profit or you're hitting stop loss, okay? There's no two ways about it. It's literally just going to be one of those things. You can set an alert at your take profit, set an alert at your stop loss, and then you'll be alerted once it happens. Until it happens, there's nothing more for you to do. You're going to train yourself to not basically fuck up your trade anymore, okay? You're going to train yourself to let your trades hit take profit, because if you're closing at you got routine take profits of 1 to 4s and things like that, and you keep closing them 1 to 2.5s, 1 to 7.5s and things like that, it's just going to be that much harder for you to really milk some profitability out of your trading. The other method, okay, which I really, really recommend, but if you're deep in this problem, then I recommend the way that I just described first, okay? So the other way is that you're going to do the exact same thing, but you're going to allow yourself to come back every 10 or 15 minutes and check your screen, check your phone, check your laptop, whatever. And then when price pulls away to the point where it's at either a 1 to 1 or 1 to 2, I will let you make that decision. Then you can go ahead and park your stop loss at break even. Okay. So I like this method, because what I did was, originally I started doing it with, you know what, I'm so fed up with this. It's either hitting my stop loss or hitting my take profit. I'm done. Okay. And I'm walking away. Then I graduated to the level where I was like, okay, I'm still going to walk away. But during my showtime, a lot of these trades that I would hit in Asia session, then I was having my showtime. I was watching Survivor and things like that with my family and just having a good time. I would allow myself, every 10 minutes, I would walk back to my office, just check on it, and as soon as it got to 1 to 1 or 1 to 2, I would just throw it in break even, and then for the rest of the night, I wouldn't even go back and check the trade. Now, sometimes, I did go back and I checked the trade and things like that, and I wasn't perfect, but the times when I did develop perfection, okay, even speaking now, I'll still do this technique. I've even done it recently. Then I won't even go back and I won't even look at the trade. I'll come back like an hour or two later and see how the trade panned out. And so that is a technique that you can utilize if you're in that specific situation. The other thing that I want to say is that I started using this to overcome a weakness and to overcome something that I was dealing with in trading. And sometimes I actually do still deal with it, and I utilize this technique. But what I found is that in general, it works really well for me. Like, I can take this technique and use it even if I'm not struggling with that at the time. And more often than not, it will allow me to walk away with bigger trades than if I would not have used it. So this is something you can try out. Again, I recommend, if you're just starting out, if you're coming from a place of having, watching 1,000 YouTube videos and just, you're just so lost, you're like, you don't even know what to do anymore. Use this. Use this method. And as you get deeper into your trading and hands-on with everything, then you can manipulate this and change it to something that works even better for you. As far as the walkaway method, there was one more thing that I wanted to say on it. Gosh darn it. Maybe I already said it. So, yeah, so utilize that method if you need to. Test it out. See how it goes. Don't just do this method. Don't think that this is something that you're like, oh, hey, I want to get really big trades. I'm going to use the walkaway method and just have like a ridiculous take profit or something like that. Remember, this is not the let it run. Okay, we're not doing the let it run and pairing it with the walkaway method. The walkaway method has a set take profit and it has a set stop loss and it's logical. Okay, we're going for a 15-minute level. We're going for a recent 1-minute level, something like that. Okay, so let's make sure that we went through everything. We went through stop losses. We went through the take profits. We went through trade management targets. And all of this is, okay, yes, we need to go through your risk management. So with your risk management, you have a few different options, okay? So let's write those in. So risk management is going to be how much you're risking per trade, okay? So generally, you want to keep this around the same, okay? It's not going to be perfect. Every single entry that you get is going to be off by a slight amount. And that's the reality of trading. So, you know, if you're trading, if your risk is $100, let's say that your risk is $100. Let's say that you're trading with a $10,000 account. Let's get out the old calculator here. Okay, you're trading with a $10,000 account. Your 1% of your risk is $100. And let's times it by 0.01 to get your risk, okay? So that's going to be 1% for you, okay? So 1% is $100. You have a few options. You can either risk 0.25%, you can risk 0.5%, or you can risk an entire percent, okay? I've been around the block with this. I've risked, we'll put in 0.25, we'll put in 0.5, and then we'll put in 1%. So I've risked everything from 0.25%, 0.5%, 1%, 2%. You know, each has its place and its value. I'm not going to say 2% here because I feel that that is too aggressive. And I even feel at times when I've done it before, then it's been very aggressive, even if it has worked out in my favor. So what I would recommend to you is, you know, I'm not saying down the line you can't get to a place where you're going to risk 2%. That's going to be up to you once you really dial in your trading and things like that. But for the meantime, I'm going to recommend 0.25 to 0.5% generally when you're trading, okay? I would even stay away from the 1% until you really, really start to get some experience in a lot of this stuff. It not only starts making sense, but you're able to replicate what's going on here in your own trading. Not just like, yeah, everything clicks, but you're hands-on, okay? And you're starting to see results with your trades. You're taking pictures of your trades. You know why the entry was good, and you know why the take profit made logical sense, and all of that stuff. And you also start to recognize things that you did wrong, okay, or need some work on. Like, hey, man, wow, you know, I see that my stop loss shouldn't have been here. So you go from a point where you're like, hey, I don't know what happened, to the point where you're like, okay, I see it. My stop loss was way too tight, man. Okay, so I'm gonna put 1% on here because you can work up to a point where you are risking 1%, but right now, stick with 0.25%, stick with 0.5%, and a lot of these trades, you know, sure, some trades you're going to be going for 1-to-1, 1-to-2, 1-to-3. Some of these trades, you know, you're going to end up getting, you know, 1-to-7s. You're going to end up getting, what is this? So that's a 1-to-265. You know, you're going to get 1-to-4s. 1-to-4 is not that big, but still a very, oh, okay, we need to be on the 15-minute. Very respectable, nonetheless. You're going to get 1-to-10s. You're going to get, you know, I just had a trade the other day, but I'm not finding it right now. It was a 1 to, um, I forgot what it was. It might have been the 1 to 10 that I just showed you. You're going to get trades like that, okay? I've gotten 1 to 40s, 1 to 30s, okay? So those trades will come and they will happen, and they will really, really compound whatever it is you're going to use for your risk, whether it's a 1/4% or a 0.5%. That will be the compounding effect when you go, man, I'm making this with with a 1/4%. So like if your account is $100 is 1%, okay? Just divide that by 4, and then we'll also do it in the half. And if you're getting, say you're getting a 1 to 3, you're getting $75, okay? If you're getting, you hit a 1 to 10, $250, okay? And if you're trading with 0.5% with $100, I'm getting on the low end here. You're looking at $150 up to $500, up to sometimes even $1,000. I mean, and then, if you're trading something with some risk that is, let's say that you have a $50,000 account, okay? Let's say that you're trading with $500 is 1%. So we'll cut that in half, for 0.5%. So as your account grows, okay, those same trades, 1 to 3 becomes 750. I mean, 750, man. That's a little chunk of change right there. Okay, you get 1 to 10s, 2,500. And again, it depends how you manage. I mean, if you're taking a little off at 1, little off at 2, letting the rest run, okay, it's going to be less. But to show you, you can really make some bank. I mean, 1 to 16, $4,000, okay? And then when you get up to the level where you are risking 1%, okay, when you get there, then all of a sudden, $100 on a 1 to 4, you're looking at $400. You take some off, maybe you're looking at $250 or something like that, okay? So you take $500, all of a sudden a 1 to 5 is $2,500. So don't be too concerned like, oh, I have to risk 1%, I need to risk 2%. That kind of stuff will come with time. Right now, just stick with a 1/4, just stick with half, keep it very simple. Get in the mindset of you're trying to build a track record right now, okay? You're not trying to take out this lump sum and have this, awesome vacation with your money or anything like that. You're just doing the basics, okay? And again, I feel kind of funny when I say basics because a lot of people, a lot of traders, they just don't understand this stuff. So consider yourself jumping up the bell curve right now. Okay, so I think we've covered everything that we needed to in this one.